Welcome to this CEO webinar, where today we have Alexander Lacik, who is the CEO of Pandora and been so for around 3 years. Pandora is a pretty amazing business. It's a Danish business, and we haven't actually seen a lot of Danish companies starting within the past 30 years of a decent size. But I think we can safely say that Pandora is part of that group. Pandora is also by volume the largest jewelry shop or network in the world, and we're pretty excited to hear a lot more about the thoughts and aspirations for the Pandora, and not least Alexander being a relatively new CEO in the business. 3 years is not that much, but and as you said to me just before this, it's just the beginning. So we're obviously super interested in hearing a lot more about that. And I really appreciate the time and attention you want to give the Saxo audience here. And a very big welcome to you.
Thank you.
Thank you.
Alex, welcome, or tjena, grabben, welcome. It's a great honor to have you in the studio. Pandora, of course, is a very well-known brand, certainly in Denmark. I think, as you will tell us during this conversation, it can be even bigger, both in terms of recognition, but also in terms of the business model. So we're looking forward to the next roughly 45 minutes in your company and getting to learn about Pandora. But why don't we start on the easy side and do the elevator pitch for me as a new investor or a investor who is interested in Pandora. Why should I buy it? What is the driving forces? What kind of company is Pandora?
So there are 3 reasons why you should consider Pandora. 1, it is the most recognizable brand in the jewelry sector in the world. So 8 out of 10 women in the world are aware of our brand. Nobody comes even close to that. So that's a good starting point when you're looking at consumer brands. The second point is we actually are the largest brand in terms of volume. So we sell over 100 million pieces every single year, which means there's a lot of consumers out there which really like this brand. Which then leads me into the third point, which is our earnings model. So all of those 2 things, a strong brand with a strong following, leads to a very interesting P&L performance, a very thin balance sheet, which means you have very strong returns, and a very solid earnings model. Within the earnings model, there's also something which is quite unique for Pandora. Most other jewelry, if not all other jewelry businesses, they are in a constant recruiting mode. So if you're in the business to buy a ring, you have to kind of market to me, I go there, I buy the ring, and then the kind of relationship is over. When you come to us and you buy a bracelet and you start collecting our charms, you will stay with me for 5 or 10 years. Which means my recruiting cost can be amortized over those 10 years. So that means that the captive business model that we have actually generates revenue streams forward all the time. And that's really what makes Pandora stand out. So I think those 3 things, a very strong brand, a very strong and loyal following, and a unique earnings model. Those are interesting reasons why Pandora could be something for you.
So we'll get to the economics, and of course, as a banker, I'm exceedingly impressed by the amount of cash flow that is generated. But maybe to just continue on the positioning of Pandora, and me being a man, I'm probably at a slight disadvantage. But would it be right to say that the proposition you make to women and some men who buy jewelry for their wife would be that you are in a price range that allows the customer to be, as you said before, a repetitive client, but also at the same time in a model which has a relatively high margin. But essentially the market for you is something people can afford to buy on a Friday. If they like it, they can forget about it. If they really like it, then they can come back and actually extend or buy other assortments of it. Would that be a right characterization of where you are in the market?
Yeah, so if we talk brand positioning, the word affordable is kind of part of our DNA. So we talk about being a desirable and affordable brand. So we serve, let's say, the middle of the bell curve. So we're not in the bottom end where you have non-precious metals. We only operate with precious metals like gold and silver. And we're not at the top end of the market, which of course from a volume standpoint is a very different game that you play. So this is a mass market proposition. So we're kind of the IKEA of furniture or the H&M of fashion, and then it's Pandora of jewelry. That's really the positioning, which means that's also why you can get this type of volumes that I was talking about before.
Sort of the sweet spot of the consumer in terms of the amount of available buys that can happen. Isn't it to a large extent very difficult to navigate affordability versus I think in your Phoenix statement project you're talking about at the same time you want to be, it's not exclusive the word you use, but you use it, it's collectability, I think is the word you use it. That balance, how as a CEO and how as a company brand and as a brand do you operate between being cheap enough but not so cheap that you sort of lose the appeal of the customer, so to speak?
So if you look at our range, you could find products for, let's say, 19 euro, just to make an example. And we have products in our range now that you would find with the most recent launch of our lab created diamonds up to 1,500 euros. But the sweet spot is around 50 euros. That's kind of where we serve the market. We only operate with, high-end designs. So we're kind of allowing people to get a taste of, let's call it high-end type of products, but at a very affordable price. So what we do not compromise on is on the quality of the product and also the design and experience of the product. So that's not where the compromise is at all. There is no compromise, but so that's very important. So the word desirable that I mentioned is critically important. The reason people come to us is primarily because it's a desirable brand. And then, of course, since it's affordable, that's what gives you the volume. If I'm only affordable, then you're purely speaking, you're just a value proposition. It's very difficult to build a brand. You can have a non-branded proposition that's cheap, if you may, but that's not what we are after. So the combination of desirability and affordability, that's kind of the magic here.
I also noticed that in some of the growth plan that you put forward, it is again to rebuild the store component of your business. I must say I'm a person who goes to, in a normal non-COVID year, to 45 countries, and I always see your brand. But you need to explain to me, and I think I know the answer, but I want the viewers to have it as well. Why is it so important to have real estate in every single country, despite the fact, and this is not a bad reflection on you, I don't think I've ever seen more than 3 people in any of these stores in 50 different countries. I'm sure on an average on a day there is much more people, but I presume there is an underlying positioning that is critical in terms of the real estate versus the cost of the real estate into the brand recognition.
So if you look at how you create awareness, in every business I've ever been in, half of your awareness comes through various media platforms, call it TV, online, whatever. The other half comes through physical presence. If you're in the niche market, let's say I'm selling Vuitton bags, I'm gonna have then they make a collection of 10 bags. There will be people flying across the world to buy that one bag. They don't sell 100 million pieces like I do. So I'm in the mass market, and the first thing you learn when you're in the mass market is distribution is king. So as your number one thing is making sure that there's easy access to your brand. So physical presence is absolutely critical. The other, let's call it fun fact, is 65% of my customers, not consumers, but my customers are men.
Can you say that number again?
65% of all the customers, or the shoppers, are men.
Wow.
Okay.
That's a surprise.
Men buying jewelry to women need help. Period. I mean, you said it yourself. I'm not that familiar, but I'm sure that you bought jewelry to your near and dear ones at some point in time. That's another reason why getting the service that we can offer in store is critically important and is a competitive advantage. Because I can go online, but online is a self-service environment. You go into a shop, you will be aided. It's an aided sales environment. There we can help you kind of figure out what it is that's likely going to make the recipient of your gift happy.
Can I ask a question? So who's driving your explosive growth online? Is that after you got you collecting bracelets? Is that women that are coming to you online and then just add on bracelets or charms? Sorry, for the bracelets.
Okay, so we need to break down the 65% to understand a little bit what's going on. So those 65%, because we essentially only sell products to women. Yes, I mean, okay, I have one, but that's far and few between. This is a female proposition first and foremost. So we can safely say that out of the 100% of people that would buy, 65% are guys. They're buying gifts. Okay. Then the other 35% are what we classify as self-purchases. So that's typically the woman that received the bracelet and now is intrigued in the proposition and comes in every now and then and starts filling up her bracelet. That's a little bit the model. If we now talk about that part of the product assortment. Then you kind of look at the composition online is pretty much the same as offline. So the behavior online and offline is the same. The things they are buying is the same. So it's the same customer. So then we kind of zoom in a little bit on the 65%. To say, okay, guys buying jewelry to their daughters or wives or somebody. Out of those 65, let's call it 40% of those are men that essentially got a shopping list from whoever is the recipient. Said, I want that piece of jewelry, okay? Easy. Then the next, let's call it 30% are people that got a very strong hint, like, I want something from Pandora. Those poor souls need help, and that's why they go into the shops, because there we can help them figure out what it is actually that they are looking for. And then you have the last, those are the really brave souls. So they didn't get a request, they didn't get a hint. They just, for some reason went into one of our shops and bought something. And that kind of, you can transpose that kind of behavior online as well. It's pretty much the same thing.
Can you get help online?
Well, nowadays you can get a little bit of help. We're working on that. So you can there's like remote selling is something which we've introduced. You can get styling tips, but it is a much flatter environment, in my opinion. So we have not yet found a way to replicate kind of, I think, the extremely good service that we can offer. The reason you go online typically is of convenience. So it's speed. You don't have the ability to run down to the shop for one or the other reason, and that's why you go online. But if you're looking for real sales help, then you go into stores. That's why our stores are very resilient. We could see that also during the corona, when shops closed, like in UK, for instance. I think this was April of the first year in the first wave. All shops closed. My sales online picked up 100% of the volume.
I saw in your statement mentioning of click and collect concept as a huge growth during that period.
So and then of course the moment the shops reopen, we see that a lot of people migrate then back into the stores. So a lot of times is conversation with analysts is like, why do you have so many shops? Why don't you do like other retailers. I mean, close down your network. It's like, no, then you need to understand the fundamentals of who my customer is and what it is that they're looking for. On top of the fact that most of my shops are very, very profitable. I run a 60 square meter shop on average, 5 full-time employees, EBIT, four-wall EBIT, typically north of 40%. So before I decide to close a shop, I will have to lose a lot of volume before I even consider. That is typically something I have to educate analysts about, because when they talk to a lot of other retailers, when they lose 10% volume, they go from black to red, so they start losing money. If I lose 10% of volume, I mean it's hardly noticeable.
It's less volatile.
So it's super resilient. So and if we think about the go forward strategy, we actually are looking to expand our network globally. We think we have still a lot of white space opportunities, so we can keep growing. And normally when we put up a shop, the return on investment is typically less than a year. So it's a very, very quick payback.
A very impressive business model. Now let's shift into using your experience as a CEO of a very successful company and try to extract some value from that. You mentioned yourself the C word, COVID, as one example of sort of obstacles that's been on the road over the last couple of years. I know for your company has meant some relaunching a little bit later than normal, but let's just talk about the macro 10,000 feet perspective. What lesson did you as a business manage to take away from COVID-19? And two, of course, how have you implemented that in the new strategy?
I think the most important learning as an organism is the resilience and the speed at which we've adapted to the new situation. So we went from one day to the other, literally. I can remember we sat in a board meeting. I went straight out of the board meeting, decided to shut the entire network in Italy, and within 24 hours we had shut 90% of our network in Europe. And we lost 25% of the volume. So we were still profitable. Even in that moment in time, we were still profitable, because we managed then to quickly take control of our costs situation. As I mentioned, we have a razor-thin balance sheet, so that is then a strength in those situations. And then we kept investing. But I think that the most important learning so far, which we can bring with us into the future, regardless of the conditions, is the resilience and the speed at which you can adapt to the changing circumstances. And then, of course, then we managed to pick up a lot of the business online that we didn't have in our stores. And that was probably more luck than anything. When I came on into the business, the previous management had not focused at all on, let's say, anything that has to do with digital. So we put in a big engine in terms of digital marketing. We completely revamped our e-commerce platform. And we did all of that just before COVID hit. So when COVID hit, we actually had a strong engine to then kind of shift gear. And I can, and if I then compare to what I see other competitors did in that same time period, we grew market share like crazy, because we were just ready. That has nothing to do with me being a good CEO. That was just a sequence of fixing the company, and as it turned out, the timing was right. But of course, that could have been something very different. But the investment into digital marketing and the e-commerce platform has proven to be very, very successful.
Alex, we need to talk about Russia and the impact for what is going on in Ukraine. First question, an easy one. How big an impact does Russia and overall this war, which is going on, have on your business in your estimation?
Yeah, I mean, from a moral standpoint, ethical standpoint, it's obviously huge for all of us. But if we stick to more the kind of financial side of it, then Russia is and Belarus is probably 1.5% of our turnover globally. So it is negligible almost.
showing my ignorance, I assume that Russians are big buyers outside of Russia too, in the sense that it is, you know, a big chunk of the luxury slash jewelry market. But you don't expect that to be a big issue.
No, I actually don't have a stat. We'll come and talk about China, I'm sure, in a while. Then I will have some statistics, but it is, our products are very much bought locally. There are a few spots in the world where tourism plays a slightly elevated role. I mean, if you go on the Gold Coast in Spain or but very few locations. So we're not dependent on tourism as a business. If you look at other luxury players, tourism is a big business for them. But for us is very, very tiny. I think we've made some estimations that tourism probably makes up 2 to 3% of our global turnover. So this is very much a local business.
The other thing which I'm sure a lot of investors wants to ask you is that we of course seen commodity prices and the precious metal prices, of course, rising significantly. This month will be the highest ever price rise that we've seen in those related commodities and metals. How big an impact is silver and gold having to your business, and how do you source the same silver and gold in your business model?
So first of all, it's important to remember that we hedge pretty much 1 year ahead. So the kind of input cost today for things I produce today is something I essentially bought a year ago. So that, which means that this short-term fluctuations we manage through the hedge. So this year I think there's going to be a headwind of roughly 100 basis points to our financials in the guidance. On the other hand, we have a positive expectation on the FX. So the net of the two is probably 50 basis points impact on EBIT. So it's quite manageable, and that's all of our because essentially it's silver is the big raw material that we're buying. We buy a little bit of gold, but essentially it's a silver game. So yes, would I love the silver price to go back to its historical level? Yes, but it's not a major issue for us as such.
The other unintended consequence, which of course neither Pandora or anyone else can control, is that this huge humanitarian crisis, of course, probably comes with a destruction of demand in the world, simply because I think it's given that we need to pay high energy prices as a cost for doing what needs to be done in terms of what happens in Ukraine. Do you see that, and are you calculating, right, trying to estimate how much a slowdown in the global top line that you are trying to get a piece from is going to impact your business? And two, how do you yourself estimate this impact over the next 12 months?
So if we go back to the crisis in 2008-9, when you had the financial crisis, the jewelry industry, the total jewelry industry, the following year-ish, the whole category shrunk by something like 5 percentage points. So not a lot. Within that 5, you will have winners and losers, which means that you will have the companies that are doing a good job can probably still grow. And then you have the people that are doing less of a good job for whatever reason, then they get a double whammy on their business. Fast forward to COVID. Actually, through COVID, we grew our business. So and the formula is the same. The people that do a good job, they will be able to capture a market share and also actually put absolute growth to your business. And then, so if I take those 2 data points, I would say I don't think it's going to be a massive impact on us, but I don't have a crystal ball. We had guided this year for some impact due to COVID. We're seeing a quite limited impact so far. So maybe I switch the COVID impact that I had in my guidance to something that has to do with this. I don't know, which suggests that maybe the range is 1 to 2 points max. Coming back to kind of the things we learned during COVID was, as I mentioned, resilience and ability to adapt. And probably the third piece, which we didn't talk so much about, is that we kept investing. So we kept investing in marketing, we kept investing in product innovation, we kept investing in the shopper experience across all of our touch points. So essentially, our brand just gathered momentum. So if we keep doing what we've done in the last 2 years, I don't expect that this should have a major impact. Now, that's with what I see today. If people start doing other crazy things, then of course that I cannot comment on. But if it's contained, let's say, to what we experience right now, I don't expect a big impact.
I think the final piece for me, before I want to leave for Peter to do a little Q&A on the actual growth and internals of your reporting on both Phoenix and the balance sheet, is that Peter and I do the input to the Saxo wage cost model. So in other words, it's actually upon Peter to give the input to the local CEOs on the cost structure. And for the record, the UK employees, at least in terms of compensation, just to keep up, will need to have 7.6% compensation this year. I think you have, if I'm not mistaken, about 20,000-ish minimum employees at Pandora totally. How do you see the cost? Two questions. How do you see the cost pressure in terms of compensation? And two, on an HR model, are you in the position like we've seen in the US, where a number of US companies have moved the annual review of people's performance into a quarterly in order to both keep up but also be at the forefront of sort of anticipation and management of the expectations? I know it's a difficult question and I'm not trying to get you out, but I think for me as an economist, as someone who live every day by the markets and what it does to consumers, I think there is in the corporate world a naive conception of that they can face this over time. So what do you say, Alex, on issues like this?
So just to correct a little bit, we have roughly 28,000 people around the globe, of which, let's call it something like 14,000 are in Thailand in our production sites. We have another, 12 to 13,000 in our shops around the world, and then we have the remaining is kind of white collar. So that's kind of one perspective. Then you have quite different perspectives country by country. So you point out to the two countries where there's probably been most wage inflation most recently, which is US and UK. So there is an inflationary pressure going up, and we've had to kind of take note of that and make sure that we're competitive. That remains important. In the rest of the world, I would more characterize this as a bit more like what we're used to. So on average, we actually have not planned for any particularly heightened salary inflation versus, let's call it, a normal year, because it's kind of across the different parts of the company, the mix that you get depending on kind of your geographical presence. So in a way, you get a basket and it kind of balances out. So it's not major, but it is clear that in the US and UK, we have seen, particularly in the retail and in the logistics centers, we have experienced, like everybody else, that people have made different choices coming out of the COVID, and there's more war for talent in that space because there's less people coming back into retail somehow. And then what we've done is, I think what we are trying to shift the narrative for this audience, where in the past was probably much more come here and do a job and that's it. We are now shifting that and saying, and this is part of the program that I've introduced to Pandora, is to say, no, we're offering you a career. So you can start at this entry level, but in fact, if you do a good job, you can sit in this chair one day. Why not? But for that, you need a system, you need career pathing, you need good managers who can train the people. There needs to be kind of a curriculum in terms of leadership and retail skills. So we're trying to make coming to us a more attractive idea. And then we're also trying to stop the narrative around talking about retail and rather talk about sales. So, it's very different if I ask you, can you come and work in my retail shop, or do you want to come and get a sales education and be one of the best sales professionals out there?
One is universal, the other one is specific, right?
Yeah. So we're trying to drive up the attraction, let's say, of coming to Pandora, because if you think about it, you can think about our store universe as I have 12,000 retail staff, or I have 12,000 salespeople. It takes you to very different places and what you can do with your company. And I'm a massive believer in that the people we have in our stores are salespeople. In smart salespeople that can kind of guide you on your journey, but they're certainly there to make a good sell. And that's why this engine is so strong, and that's why we can put the growth that we're putting behind us.
Now, Peter, on to the more precise science of accounting and reporting.
I don't know how precise science it is, but I was maybe, just before we go to some of the numbers, just go a little bit back to some of the ramifications from COVID. So China is one of your 7 core markets. In your Q4 statement that was out recently, it's clearly one of those markets that are still weak. And China, chose a very deliberate zero COVID strategy that have had implications for global supply chains, but it also have implications for internal consumer behavior and dynamics, how easy it is to travel around, etc. And what are you seeing on the ground? I mean, I saw you have postponed some of your investments. I'm just curious to see what are you experiencing in China right now, and what's the path forward from here?
So first of all, every single country in our network is in a good place except China. Okay. So and normally you always have, when you run a global business, you always have headache somewhere for some reason. So but if I look at kind of from an underlying performance standpoint, we're doing really well in all our core markets with the exception of China. Then to size it up, China is roughly 5% of my global turnover. In Q4, which is the period you mentioned, it was only 2% of my global turnover, because that's kind of the big gifting moment in every market except China, because Christmas is not a big thing in China. So you can say that, okay, so China is not a major factor in my book today. That's true. On the other hand, if you zoom out and look at market opportunity, this is the single largest jewelry market in the world. So of course the question you have to ask yourself as a CEO, so do I want to keep it small and not have headache with it, or do I actually go for it and try to get a good market share in China? And that's obviously what we're trying to do. And we've done a lot of work to see whether, it's easy to say that you want to be big in China, but to get there might not be so easy, as you will find. But we've done a lot of work on trying to validate whether, is Pandora a proposition for the Chinese consumer. And after all of the work that we did, we found that yes, of course, once the Chinese understands the Pandora proposition, it is going to be very interesting. Then to a specific question, what we see on the ground. So essentially the poor performance that we're experiencing is on one hand due to the zero tolerance policy that the Chinese government is executing, and I have nothing to say about that. And then that's paired with kind of me being a weak brand. So somehow there are two negatives at play right now. We intended to actually relaunch the brand last year in August, but that's essentially when COVID started coming back. So I said we're kind of sitting back a little bit, waiting for the situation to clear up, because as happened last year, was from one day to the other, they found 20 people with COVID in Shanghai, and they shut a city of 25 million people from one day to the other. In that environment, it is not responsible to go and invest a lot of money.
No.
Because I might spend all that marketing money and for the government to shut the whole environment. So what we've said now is we're going to sit back, we have the plan ready to go, but we'll wait until at least there's more predictability in the situation. Because this thing might carry on for quite some time still. So, and I don't want to kind of let just time run away from me. I have over 200 stores in China, which we still want to service. So at one point in time, hopefully this year, we can start kind of investing back in China.
All right. And talking about investing and growth, so the way Pandora has been a phenomenal growth story. And as an investor myself, but also as an equity strategist, analyst, it's a phenomenal company in terms of return on invested capital. As you said, it's a light, capital-intensive balance sheet. We like that. It generates a lot of free cash flow. So it's really what you would call a high-quality company. But the caveat is, when I look at it, it's you're valued at almost 10% free cash flow yield. So when I compare Pandora's valuation to typically high-quality company with the same characteristics like you, something is at odds here. And I was wondering, it's almost like the market is pricing you to be a very low growth company for a long time. And I think that speaks into your Phoenix strategy. Here you really want to get back on the growth track, and I saw the last 12 months you just hit again a new record in terms of revenue that in all of your history. So I want you to talk a little bit about how you get back to that growth story and convince the market that it's there, it's durable, so you can get a higher valuation. And then also, so you focus on the growth, but I'm looking at your EBIT margin sort of guidance. And when I compare it to the period you had before you were in sort of, the wrong execution before you took over and you had a little bit decline in your sales, you're not guiding that you'll come back to those levels. Why is that? What's the structural issues behind that?
Okay.
Yeah.
So first of all, this is a great example where the market is wrong, right? All the analysts are wrong. No, I'm just kidding. But if you would blank out the brand name of us and take my balance sheet and my P&L and the last few years of performance and line up a couple of other well-reputable company within my sector, you would put a very different multiple on Pandora. I'm quite convinced. Now, as I always say, my job is not to try to manipulate the share price. The market will judge us for who we are, what we do, and that's kind of where we're at. So my commentary is going to be much more around what our plans are. I can have some viewpoints if you kind of, the company was IPO'd in 2010, if I'm not mistaken, and since then there's been a bit of a roller coaster journey if you look at the share price. But if you overlay that with the consumption during that period, the consumption track would look something like this, give or take, and the share price volatility would look like this. So that delta is only explained by either misunderstanding, expectations that are not fulfilled, or all sorts of other things. But if you what we have said with the Phoenix strategy, what we would like to be understood as is that this kind of curve is also replicated in the share price view of the company. So we talk a lot about balanced top and bottom line growth. We talk a lot about being predictable. We put a big premium inside the company on keeping a high say-do ratio. So we don't overpromise, but we keep delivering, and that's how we rebuild that trust, which I think is actually the core component of this volatility that's out there. Because as you say, if you look at the stats and the metrics, it is very difficult to compute why the valuation is what it is. Then a bit to going back in time, so yes, the company was cruising with EBIT margins in the 30s. But a few things to mention. There is a reason why the company started declining, was because it wasn't investing. So what I've inherited is a company which is grossly invested in many aspects of the business. So actually, if you want to run a business sustainable over time, you need to invest in the right places. So of course, yes, I could jack up the EBIT margin quite easily, but for how long would that be? And then we're back into this whole thing again. So I think that's one important point. If you then have a look at the competitive set and where the multiples are, in a different range, let's say, these companies, typically speaking, not all, but typically speaking, have actually lower EBIT margin performance than we do. But what they do have is a very consistent top-line performance.
Yeah.
So my viewpoint is that's kind of where we want to go to as well. So we don't kind of overstretch our EBIT promise, but we make sure that we keep investing in generating a predictable and quite interesting growth versus the marketplace. So that's really where I want to go. If I get too keen on dropping too much to the bottom, I have less, let's say, juice in the tank, and I cannot then drive the company the way I want to drive it.
But I think it is the right way to go. We looked at 2,000 companies in Europe and the US, and there is a very clear pattern that the less volatility you have in your annual sales growth rate, but also more specifically in your operating margin, the more stable it is, the higher your equity valuation is. It's also what's driving healthcare companies to very high valuations, because it's very predictable. So it's very easy to model the company. So I really think that's one of the key things. But you need to talk more about Phoenix, and inside the Phoenix strategy, I want to pick your brain on. I mean, how big an ocean are you actually fishing, and are there any limits to how big you can get, or how big are you? I mean, at one point you can, because your position is already largest on volume, but how big can you become in the entire industry?
How long is a rope? So if you look at so let's size up a few things here. So first of all, now the interesting thing about this category is that there's actually not one source that is fully reliable on the market size, which is very odd. But it's, of course, there's a lot of companies, it's very fragmented, a lot of them are privately held, which don't report numbers. So we try to triangulate the size of the jewelry market, and it suggests that it's somewhere around $250 billion in size. That's retail value. So our market share is small.
Yeah.
Okay, so that's one way to look at it. The other way to look at it is that 70% of our business is related to the bracelet. So what we call the Moments platform, charms and bracelets. Bracelets as a percent of the total category is 17%. So we're kind of a big fish in a small pond. And now you get into the classical branding question. It's like, okay, so you're really good over here. How far can you stretch your brand while still staying kind of true to your core identity? And this is really the game forward. That, in a nutshell, is what we're trying to do with the Phoenix strategy. Of course, it got a lot of components, but that's what we're trying, if I dumb it down, is about trying to stretch the brand a little bit so we can tap into other usage occasions or other moments in life where Pandora as a brand can be meaningful and be a strong proposition. So that's really what we're trying to do. And then we can talk more about how we do that. But that, if you want to kind of think about where is Pandora going to grow, that's the map. Try to stretch a little bit out from where we are right now.
So, preparing for this meeting, which is today, which of course is a great honor, Peter and I was shocked to read your Phoenix document, which in my count was way in excess of 100 pages. And to be honest, I'm a trader. I don't have the attention span to go through 100 pages. So why don't you tell us in 3 or 4 points what is Phoenix really, and why does it matter so much for you as the driving force in going forward with Pandora, please?
Yeah, good question. So Phoenix, in its simplicity, is a growth strategy. So we focused on the value creation opportunity in our businesses by driving top line. We have a phenomenal earnings model that I mentioned before. Top line, it kind of comes through. So that's how we think we can create most value. So therefore we centered the whole strategy around 4 things, which somehow all interlinked to generate growth. But rather than using the kind of corporate language, let's say, that we have there, where I want you as a customer to understand Pandora. So today when we speak with our customers, we're first and foremost, we are famous for the Moments bracelet, which is 70% of our business, very profitable, generates very good growth. We know how to run this business. Let's say 5 years from now or 10 years from now, I want you as a customer, when you're in the market to buy jewelry, not bracelets, jewelry in a wider sense, to say, well, Pandora is one of the brands that I'm going to go and have a look at. That's essentially what Phoenix, where the growth is going to come from. So what does it mean more concretely is to say the type of product platforms that we can offer in there is more than just this bracelet. So we've launched now lab-created diamonds collection. We have a classical or it's called timeless collection there. We've launched something for Gen X, which is our most recent, that we call Pandora Me. But so different collections that serve different purposes and can create incremental growth versus this thing. That's kind of the output. So we would like you to accessorize with more of our products. What we also pay a lot of attention to is the customer journey. So our industry is a very traditional industry. It's kind of a craftsman industry, so it's very analog, and that goes through pretty much everything inside the company from start to end. We're on a mission to let's say that most companies are analog in the middle with some digital bolt-ons. 5 years from now, we would rather be a digital in the core and then have analog bolt-ons. So there's a massive transformation that we're going through. But the purpose of this is so that we can offer you a better shopping experience. Today, the shopping experience starts online, primarily. And then you will go through various platforms. You will maybe go into our stores, maybe go into one of our partner stores. You maybe go back online, but it's all connected somehow. And if we can follow you and serve you with the right message at the right time, then we can provide you with a much better experience. And for that, you need a digital engine that can power this journey. So that's at the heart of our Phoenix strategy. So broaden the portfolio of products and give you a better shopping experience in a nutshell. So you don't need to go through the 100 pages.
Thank you, Alex. That saved me a lot of time. But I also presume inside the Phoenix project sits what most investors are, and I noticed in your ownership, you have more than 50% of your ownership, it's institutional clients, which I'm sure when you do similar presentations to what you're doing to us today, always comes with the question, what are you doing in the E, the environment? What are you doing in the S, which is the social? And in the G, I'm pretty sure you're pretty much okay already, but also in the G. So I presume, am I right to assume that you have more and more demand on you from the institutional side, but certainly also from these up and coming generation who have a different view on recycling, on the way that you conduct yourself, and I already warned you, we also have to talk about your management group being almost exclusively men as well. But tell us and take us a little bit through, one, how you see that demand from institutional and consumer side, and thirdly, how does that go and work in terms of the Phoenix project?
Okay, so in the Phoenix project, what sits in the middle and what kind of powers the whole thing is our purpose, where we talk about giving a voice to people's loves. That's kind of purpose. Then kind of the next circle of that is the 4 growth pillars, let's say. This is all, there's a foundational layer there with 5 areas that we picked. One of them is obviously ESG. So that's kind of, but the starting point here actually doesn't start with Phoenix when we talk about ESG. It actually started with the founder, Per Enevoldsen, who founded Pandora. He had, I think, a very developed sensitivity around those type of topics. And now I'm talking about this well before WHO established these 17 goal areas. So if you go into our factories, for instance, in Thailand, you will find that we have always paid a little bit more than the market. We are providing healthcare, we are providing education for these people. We help rebuild schools. Just some of these things. We essentially take care of 90-95% of our waste. Either we reuse it, resell it, or somehow take care of the waste. We have the only LEED certified factory in Asia, which is kind of the gold standard when it comes to taking care of this. So what I'm trying to say is, actually, ESG sits at the core of Pandora and has always been the case. Then when I came here 3 years ago, what I also realized was that we actually don't have any targets. So we have done a lot of good things, but there was no clarity on the targets. And of course now, as your first question is, institutional owners, but not only institutional, I think everybody today asks the question, how good a corporate citizen are you? So I said, so without targets, it's very difficult to define, and it's actually very difficult to have a conversation with NGOs, even our employees, etc., etc. So then we had a big debate on where do we position this? How important is this for us? And since it sat at the heart of our business, we actually said not only should we kind of establish those goals, we actually want to be the thought leaders in our category. Given the size that we have and the impact we can have on our industry, and then I'm talking not just the jewelry industry, but the luxury industry in general, we can actually set an example of how to do this. So we have set out 3 goals. So I'm a big believer in staying very focused and then landing big impact rather than being able to tick 17 different things and actually not achieving a lot. So the first one we said is obviously around CO2 emissions. So the Paris Agreement wants everybody to go to net zero by 2050. We want to be there 10 years earlier. By 2030, we want to have eliminated 50% of all CO2 waste. And that's across not only our own value chain, but also our suppliers' value chain. So the full value chain needs to be eliminated 50% by 2030. By 2025, we'll be 100%, we'll be net zero in our own operations. So we have a very aggressive agenda. And then you'll ask me, so what does your plan look like to be net zero? I don't know. I have a pretty good idea up to 70% of elimination, but I think it's less important. What is important is you set out a very bold ambition. You bring along your partners on that journey, and then you'll figure out how to get there. That's much better than kind of aiming too low. So that's CO2. The other one is around circularity. So by 2025, we will only use recycled silver and recycled gold. So you will not have to go and dig in the ground when you buy products from Pandora. We will only operate with recycled metals. Today, we're at the 60-65% level. So we have another 3 years to go and we'll be at 100%. And then the third one is around I&D or inclusion and diversity, where we've set gender-specific goals. So by 2030, our ambition is to have a parity from vice president and up. And if you then look at our company, you would find that our board actually is 50-50. We have a challenge when it comes to layer 2 and 3, which is my ELT, executive committee, plus one level below. There is only roughly 20-25% women. And then when you drop into the layers below, it's essentially 50-50. So there is this kind of executive level challenge that we have in front of us. But we will get to 50% or parity, if you may, by 2030. Now, this is a quite crude metric because actually diversity is so much more than just gender. We can talk also about people that don't even want to characterize themselves of either of the two. So there's another, let's say, complication to figure out how to deal with underrepresented social groups, etc. So we actually have a wider view, but the kind of core metric that's being discussed in particular with institutional investors is, male-female ratio. So we have some work to do with a very specific plan. It even now sits in all the ESG metrics actually sit as a big component of the long-term incentive program. So it's 25% of the LTIP program for all of the executives. So it's a serious. I think this is the highest ratio amongst the Danish C25s. So we've made a big statement around and a big commitment around actually delivering. So we mean business in this space. So we want to be industry leaders. We want to show the way.
Talking about ESG, maybe it's related to it, maybe not, but Steen and I was talking about operational risk. So one of the things that have come out of COVID as well, and we had a great conversation with the CEO of DSV, the Danish logistics firm, and that is that global supply chains have been shown to be extremely vulnerable because it seems to be has been an over-optimization in the corporate world, putting 90% of your production in one country. In this case, for many companies, it's China. You have a large, I don't know whether it's 100%, but you have a very large amount of your production being conducted in Thailand. Do you see that as an operational risk? Is it part of Pandora's journey going forward to maybe diversify manufacturing to several countries so you're never really vulnerable to developments in a single country? What's your view on that, or strategy, if you will?
So if we just describe the current situation, so we have 2 sites in Thailand currently, one in Bangkok and another one in the northern parts, which is called Lamphun. And in Bangkok, it's actually several buildings, if you may. So from a risk standpoint, there is some dispersion of risk. Now, of course, from a country standpoint, it's all in one place. So that's one side of it. The other one is if you look at the volume that we are now kind of the demand of volume is going in the positive direction. So we actually, if we don't do anything, we'll run out of capacity, which in a way is a positive problem. So therefore, what we have just agreed this year is to build out an extra site up in Lamphun, and then we're going to have a greenfield project in Vietnam. So we're trying to, and this is both from a volume standpoint, but also from a risk mitigation standpoint. So we don't need all that capacity, but we will have an ability to mitigate risk in case something unexpected happens. So yes. Then when it comes to from a transportation standpoint, I know that a lot of companies have suffered through COVID. We essentially air freight everything. I mean, our products hardly weigh anything, so we have not really experienced any issues with freight. Okay, the flight rates have gone up a little bit, but again, it's such a small proportion of the sales price of an item, so it's totally manageable.
All right.
I think we are very close to closing off, Alex. It's been really amazing. I think there was a few eye-popping statistics in there. I think I'm going to sleep on the 65% of your business originating from men as one component. I think from our chair, I think Peter said it directly to you. He agrees that the transition you're on, where you want to do the top line more stable and then maintain the operating digitalization, essentially is what I hear you. I hear you say that the ESG journey is only just started, and it will be a central part of the who you want to be in terms of the corporation. So maybe the closing question from me is that, not to put you on the spot, but how do you see Pandora's role 10 years from now? It's almost like you asking your own daughter or son where you want to be in 10 years time, but I think. And I think you've shown that today that I think inside your head there is actually a vision for where you want to be in 10 years. So why don't we close on you? What is that vision when you fall asleep at night when you think about Pandora 10 years from now?
So what's really at the heart of any brand is that it's desirable, that it's hot, that people really want to buy the brand. So for me, it really starts about that the brand continues to be hot and interesting, because once you have that as a starting point, then it gives you a canvas of things that you can then do. I think we will see that when you walk, as I mentioned before, when you walk into a Pandora store, whether it's online or in the physical world, a much richer assortment. When you walk through the door, hopefully we can identify you quickly, so we know maybe how we can better serve you. We can follow you on your digital journey before you actually end up with a transaction. So I'm less focused on the transaction. I'm much more focused on the experience that happens before. And all those things together makes us a very interesting thing for you to consider when you're in the jewelry space. So I think that's kind of where we'd like to be.
Not to correct it, but I also hear you saying about this focus on not talking about resale but sales, but actually the employees of Pandora is going to be a huge part of the journey. And it sounds to me like you want to educate and spend money on the further journey on that. And I think on that note, I think anyone that realized that is the way you go forward is only going to meet more success than they already have. So on behalf of Saxo, behalf of our clients, I want to say thank you, Alex. I know you're a busy person and a busy schedule. So it's been an absolute pleasure to talk to you, and I wish both you personally, as the CEO of the company, but also Pandora, all the best for the rest of the year. Thank you very much for coming.
Thank you very much, and thanks for having me.